Welcome, viewers and aspirants. We hope you are all well and please do maintain social distancing even in the crowd. Thank you. Today's topic is economic crisis and Pakistan's current economic situation, an analysis. Now, first of all, we have to understand what is an economic crisis. Economic crisis is a situation in which the economy of a country experiences a sudden downturn, period of shortage in production, marketing, and consumption of products and services. Economic crisis is a situation when the economy has a slowdown of economic activities due to financial or bank crisis, inflation, currency crashes, or sovereign debt. It is a situation in which the economy of a country experiences a sudden downturn brought on by financial crises. Economic crisis is usually seen as a situation in which the economy of a country experiences a sudden downturn in its aggregate output or real gross domestic product, that is GDP. The result of the economic crisis is a decline in real income, that is per capita, and increase in unemployment and poverty. The concept of crisis, which is widely used in literature of various disciplines and in daily language, has its etymological roots in Greek krisis. The concept of economic crisis first entered in social sciences literature in 1960s. Economic crises experienced in natural economies are usually a product of negative fallout in the economical and political cycles and structure. But it could be stated that economic crises are a general outcome of macroeconomical instability. Now, history of economic crisis. First is Tulip Mania 1637. Though some historians argue that this mania did not have so much impact on the Dutch economy and therefore should not be considered a financial crisis, it did coincide with an outbreak of bubonic plague which had a significant effect on the country, with its mind in difficulty to tell the crisis was precipitated by over-speculation or by pandemic. Second is credit crisis of 1772. After a period of rapidly expanding credit, this crisis started in March or April in London. Alexander Fordyce, a partner in large bank, lost a huge sum shorting shares of East India Company and fled to France to avoid repayment. Panic led to a run on English banks that left more than 20 large banking houses either bankrupt or stopping payments to depositors and creditors. This crisis quickly spread to much Europe. Historians draw a line from this crisis to the cause of Boston Tea Party, unpopular tax regulation in 13 colonies, and the resulting unrest that gave birth to an American Revolution. Third is stock crash of 1929. The crash starting on October 24, 1929 saw share prices collapse after a period of wild speculation and borrowing to buy shares. It led to the Great Depression, which was felt worldwide for over a dozen years. Its social impact lasted far longer. One trigger of the crash was a drastic oversupply of commodity crops, which led to a steep decline in prices. Fourth is 1973 OPEC oil crisis. OPEC members started an oil embargo in October 1973, targeting countries that backed Israel in the Yom Kippur War. By the end of the embargo, a barrel of oil stood at $12 up to from $3. Given that modern economies depend on oil, the higher prices and uncertainty led to a stock market crash of 1973 to 74. Fifth is Asian crisis of 1997 to 1998. The crisis started in July 1997 with the collapse of the Thai baht. Lacking foreign currency, the Thai government was forced to abandon its US dollar peg and let the baht float. And the last one is the 2007 and 8 global financial crisis. This financial crisis was the worst economic disaster since the stock market crash of 1929. It started with a subprime mortgage lending crisis in 2007 and expanded into a global banking crisis with the failure of investment bank Lehman Brothers in September 2008. Huge bailouts and other measures meant to limit the spread of the damage failed, and the global economy fell into recession. Now we have to understand Pakistan's current situation. Imran Khan, whose claim to political power was based on the promise of a new Pakistan, seems to be falling out behind on one of his vows to make the country's economy stronger. As a recent media report claimed that Pakistan is now facing its biggest economic crisis in history. According to the News International, one of the largest English language newspaper in Pakistan, the country is in the throes of a deep financial crisis. With the Imran Khan-led regime ideally requiring to gross external financing of near about $51.6 billion within a 2-year period, that is from 2021 to 2023, in order to fulfill its needs. As per the report, Pakistan gross external financing requirement stands at $23.6 billion in 2021 to 2022 and $28 billion in 2022 to 2023. The development comes despite the very conservative estimates assessed by the International Monetary Fund, that is IMF. Pakistani authorities are now reportedly trying to make a last-ditch effort to strike a staff-level agreement with the IMF to bridge the gap of external financing requirements. In a recent report, the World Bank noted that Pakistan has joined the list of top 10 nations with the largest foreign debts. Citing the International Debt Statistics of 2022, the News International reported earlier that there lies a wild divergence in the rate at which external debt is accumulated in individual DSCI eligible countries. Including the group's largest borrowers, which include Pakistan, the World Bank report also pointed out that Pakistan's foreign debt increased by 8% in June this year. Another report revealed that Imran government had borrowed near about $442 million from the World Bank. Here we have to understand what is DSCI. DSCI, or COVID-19 Debt Service Suspension Initiative. COVID-19 has dealt a major blow to world's poorest countries, causing a recession that could push more than 100 million people into extreme poverty. That is why World Bank and the International Monetary Fund urged G20 countries to establish Debt Service Suspension Initiative. The DSCI is helping countries concentrate their resources on fighting the pandemic and safeguarding the lives and livelihoods of millions of most vulnerable people. Since it took effect on May 1, 2020, the initiative has delivered more than $5 billion in relief to more than 40 eligible countries. The World Bank and the IMF are supporting implementation of the DSCI by monitoring spending, enhancing public debt transparency, and ensuring Provident Fund borrowing. DSCI borrowers commit to use freed up resources to increase social, health, or economic spending in response to the crisis. They commit to disclose all public sector financial commitments involving debt and debt-like instruments. They also commit to limit their non-concessional borrowings to level agreed under IMF programs and the World Bank non-concessional borrowing policies. The World Bank report of October. On October 11, the World Bank, in its International Debt Statistic 2022 report, said that Pakistan was one of the top 10 countries with the largest external debt. The country was eligible for the Debt Services Suspension Initiative as a result of the impact of the COVID-19 pandemic. The report also said Pakistan's foreign debt rose to 8% in 2020 to $108.53 billion from $100.83 billion in 2019. Net inflows from private lenders increased by 15% during the period to $14 billion, but mostly represented rollovers and extension of new credits by commercial banks under IMF programs. The foreign direct investment inflows to Pakistan fell 5% from the previous years to $1.9 billion in 2020. FDI inflows were mainly in power generation and the telecom sector from the British and Chinese investors. Credit rating agencies. The News International reported that credit rating agencies are likely to further lower Pakistan's ratings, making it difficult for the cash-strapped country to raise funds through international bond issue. Now, Pakistan is going to fight the crisis. The Pakistan government is trying to reach an agreement with the IMF in Washington to bridge the gap on external funding requirements. Without IMF support under the existing $6 billion Extended Fund Facility, that is EFF, Pakistan's massive gross external financing will be at risk. The News International, one of the largest English dailies in Pakistan, reported the World Bank and Asian Development Bank have already suspended their loan programs to the country. But the two multilateral creditors will continue to disburse project loans, which are likely to be very low given Pakistan's capacity to implement projects. The last concern in this regard is what IMF wants. The IMF has asked Pakistan to remove distortions in the taxing system and align its varied GST exemptions and rates with the standard rate of 17%. Pakistan is, however, opposed to the idea as it believes that the move will further marginalize the agricultural sector in the country. We hope that you'll like the video. As these videos need a lot of efforts from our end, all we ask from you are some likes, shares, and subscription of the channel as a token of gratitude. Thank you.